Hello, welcome to Al Stock Trades. In this video, we're going to go ahead and do a short intrinsic value calculation by taking some assumptions made by the current CFO of Clover Health. We're going to go ahead and cut approximately $1 billion of revenue for anticipation of the ACO downsizing that Clover is going to do. We're going to go ahead and set new price targets, and I'm going to explain the philosophy of why this is an important decision to achieve profitability in a market that's ever so changing. I've been analyzing companies for over 10 years. I'm a typical value investor with a hint of growth, and we're going to go ahead and show you our platform on how we value companies and essentially how we try to outperform and beat the market in over a period of 5 years plus. Without further ado, let's get started. So as you can see here, I'm going to use some numbers from the financial sheets, which, some are coming from the balance sheet, the statement of cash flows, and also the income statement. And we're going to utilize all these components to essentially generate a investment thesis. Now, I'm going to use 477. Or we can just up it by 478. This is assuming these are numbers are in millions in shares. This is assuming essentially that we are going to end up getting into that $25, $30 range in the future, and all those shares that are off the float that are going to come into the float are going to be reestablished. So we're going to take that number instead of the current shares that are, essentially circulating within the market. So with this, if you can do me a favor, like this video so we can so other people can see this investment thesis, because unfortunately, not a lot of people know about Clover. And if they hear Clover, they have some stereotypes associated with it. So if you're liking this video and helping us share it, will obviously help retail investors thrive and also help out the channel. And I highly appreciate it. So in this analysis, we are going to not use these numbers as this was pre-IPO /SPAC. We're going to use 2020 numbers, 2021 numbers, but we are going to ignore 2023 numbers because we are going to most likely grow this year approximately $3.3 billion. We are going to ignore that, and we are going to show you why. So with this, we are going to do an intrinsic value to find the value of the company. Again, like I promised, the more data we get from this institution, the more we are better able to accurately predict the value of the stock. I'm going to explain to you why I'm bullish on the specific decision that they created in order to essentially lower the ACO reach in order to achieve profitability. Think of Clover as a growth machine. And right now, the growth machine does burn money. But the stock market is not rewarding growth as it did in 2019 and 2020 and essentially 2021. It now is rewarding profitability. So companies need to change their dynamics in order to thrive in the markets. So with this, in 2020, they made around $690 million. In 2021, they made around $470 million. In 2022, they made around, I'm going to put the number up here because we're not going to use it. They made around, or going to make around $3.3 billion. We're not going to use that number for 2022. But what we're going to do is we're going to estimate 2023's revenue, and it's not going to be 3.3 billion. I'm going to assume lower. I'm going to assume 2.3 billion, which is 2,300 millions. So you might be asking yourself, wait a minute, Al, if we compare the revenue from 2022 to 2023, that's going down. But again, you have to understand this was a change in their business model, which as a value investor, I don't necessarily like. But since they're changing it for the probability of increasing future free cash flows, it directly applies to our intrinsic value calculation, which makes it a much more predictable stock. I appreciate that. We want to, strive on helping retail investors thrive in the market. I mean, that's the ultimate goal, because I've seen enough in the past 2 years to conclude that, you guys need help. And this is what we've created. We're a research database. That's literally what we're turned into. So we're going to be doing is we're going to estimate the growth of this now, and we are going to attach different growth rates. Now, we can utilize this growth in, say, 2020, they grew at 690 million. And in 2023, they're going to grow 2.3 billion. And we're going to get a 49% growth rate. But we're not necessarily going to do that because we have a little bit more data. We're not going to use 49%. We're going to use the 25 to 30% growth rate leeway that they gave us. We're going to go ahead and use a 25% growth rate in the beginning. But before we do that, we have to estimate the future free cash flows. We're going to go ahead and put 478 million, like we said, and we're going to go ahead and do 5% of the revenue. Now, looking at the new CFO, I imagine that it is probably going to be anywhere between 7 to 10%. And if we do get this SaaS-like business, then this type of percentage is going to increase, which means that the future free cash flows are going to be much more plentiful. But we're going to be conservative in the matter, and we're going to do 5%. So with that regards, we're going to go ahead and multiply this out. And this here, I'm going to label it estimated future free cash flow. And we're just, doesn't matter what year we put it in. It honestly just takes the average, 34.5, 73.5, and 115. So by doing this and not putting just no short-term growth rate of years, we automatically see that the intrinsic value calculation calculates the value of Clover without any going 10 years into the future at a recession level of 77 cents to a bear case of $1.22 to a base case of $1.51. You see how the power of this, which is exactly what it's been trading at. And we know the book value sits around the recession case of 77 cents, more specifically 80 cents, which we have right around here. If you look at the book value, right around here, 82 cents. Okay. All right. So now that we've established this, now what we're going to do is we're going to push this company 10 years into the future, and we're going to discount at a 10 to 15% discount rate, even more, to get the value of the company based off of this growth rate. Now, I'm not done yet. We're building our investment thesis. We're shaving. Think of an ice sculpture. You start out with a brick of ice, and you're slowly cutting the ice sculpture, and you're creating something of value. And you're trying to essentially predict theoretically what is the value of Clover Health, utilizing a discounted cash flow statement to find the intrinsic value of the company. Okay. So by doing this, then you get a recession level of 269, a bear case of 534, a base case of 724, and a bull of $10.48. And it's really great because you can see Chelsea Clinton really hit hard around this price target of $2.69. Because again, it is the recession case level, and now it's even discounted even further. Okay. So now let's make a couple of assumptions. So let's now turn the growth rate to 0%. Let's assume we're going to grow at 0%. If we do that, we go back down from 70 cents as a recession to a bull case of $1.72. So you can see what the market is predicting now for this company. It's going to grow 0% for the next 10 years, which me and you both know that's not correct. Okay. Now let's go ahead and let's assume that we are going to do the estimated free cash flow of 2023. I'm sorry, of 2022 of 3.3 billion. If I'm losing you, please let me know. We're going to go ahead and just make a quick assumption, and we're going to put 165 for the free cash flow. By growing 0%, the company's worth based off of the free cash flow of the higher growth rate is anywhere between $1.50 to $3.82. Okay. But that's not accurate anymore because they're going to be limiting their ACO reach. So we're going to go ahead and take that off. Okay. And we're going to apply a 25% growth rate. The difference that I want to do now for the estimated free cash flow is I want to take out 2020 and 2021 because I'm assuming that we are going to grow more than $1.5 billion every year. In fact, next year, we're going to grow 2.3 billion. And the next year after that, we're most likely going to grow 25 to 30% from the 2.3 billion rather than 25 to 30% from the 3.3 billion, if that makes sense. Now, most likely what Clover likes to do is they like to promise and under deliver, but I'm saying this wrong. They under promise and they over deliver. Okay. Which is good. That's the brand that you want to create, especially for investors. Okay. So, like, you don't want investors to not be excited during your earnings report. You want them, this is like Christmas for them, right? Just an example for the retail community. I know some of you follow Tattooed Chef. A lot of investors that are in the Tattooed Chef arena, and I don't want to advertise for them. They're a terrible company. But their investors hate and they dread their earnings report because they're scared because they've missed them at some points. Investors are not happy. Okay. So with this regards, we're going to go ahead and we're going to use 2023's estimated free cash flow of 115 million. And we're going to go ahead and stamp it at that value. We're going to grow anywhere between 25 to 30%. Based off of this, I believe in 2023 and 2024, Clover stock price, in bleeding into 2025 as well, Clover stock price is going to be anywhere between $11 all the way up to $23. So it's either going to be 11 all the way up to $23. And if I have to make a better estimate, I would say anywhere between, I think that's a good estimate. Anywhere between $11 to $23. And if we go ahead and push this up, that's a good estimate. So you could go ahead and take a 20% discount rate off of that, or you could just find the average and you can say, $15-ish to $23, right? So that's going to be my bracket, honestly, for Clover. And from the year of 2023, 2025, we are going to see a stock price somewhere near the ballpark range of $11 to $23. Okay. Now, why? Why am I saying this? And why do I have a high degree of confidence? Well, the reason being is because they are now going to strive to become profitable. Okay. The only thing that could happen that might change that is that in 2024 or possibly 2025 to 2028, they could turn on the growth machine. And if they turn on this growth machine, then we're going to start increasing the revenue. But you have to understand, if we were right now, imagine 2020, we're living through 2020. We have a shutdown. The market and the interest rates are at near 0%. And all of a sudden, Clover jumped from 25% to like 80% growth rate. What do you think the stock price is going to do? The stock price is going to just shoot up because that's what the market is rewarding. The market is rewarding growth. But right now, the market doesn't care about growth. So now they have to moderize it and they have to essentially modulate it to fit what the Federal Reserve has planned for the U.S. economy. Now, whether you agree with that, that's just the real capitalistic controlled nature that we live in. And I'm happy that they have the stethoscope on the heartbeat of the U.S. economy because you don't want to fight the Fed, okay? So in this regards, I believe in the next 2 to 3 years, the stock price is going to ascend to its intrinsic value. I would say anywhere between $8 to $10. And as the company continues to perform and outlines its objectives in 2024, the stock price will then continue to swaddle anywhere around $11 to $20, which then if you go ahead and insert the current share price of around $1.30, that is a return of anywhere between, 600 to 1,600%. That's 6 to 16x your money. Okay. So, and that's from the current share price of $1.30. And this is where we value investors. What we like to do is, if you like the company at 10, then you're definitely going to love the company at a dollar, right? So if we go ahead and increase our discount rate, if we increase it to 30, I want you to look at the green line. Look at the green line. We're going to increase the discount rate. 40, 45, 46, 47, 48, 50. There it is. So what we're seeing here, let's do a 51. Okay, fine, 50. What this is telling me is I should expect a 50% return year over year for the next couple of years until we reach the intrinsic value of anywhere between $11 to $23. Okay. And this is taking multiple calculations and sending them 10 years into the future in the green line, 10 years into the future into the yellow line, 10 years, 10 years. And we're basically trying to find this value of Clover. And what the beautiful part about doing intrinsic value calculations, ladies and gentlemen, is that it helps you find companies that are undervalued that the market is mispricing. And once that it goes up to its intrinsic value, many retail investors will look at the historical growth of that company and they would say, wow, it grew up 10x in the span of 24 months. Imagine if I buy it now, I might be able to double my money again. You get what I'm trying to say here? And this is when we are going to most likely sell to those investors because they don't understand. They think, and they might win maybe a couple of, they might win 20, 30% on their money, but chances are if they hold and they buy more at the peak, they're going to end up losing. And that's what I'm trying to teach retail investors, not to get stuck holding the bag at buying things at high values when they're overvalued, but buy them when they're underpriced. Buy them when no one wants them, and then sell it to when all people want them. Okay. So let's go ahead and let's read this comment, and then we will conclude this. Please share it. If you like this, consider liking the video, subscribing, and we also have a Black Friday sale that'll be ending shortly. The biggest sale we ever going to have, $500 off out of our all intrinsic value calculations, our future lessons, and our software. And we are going to be increasing prices after. So definitely take advantage of this. The comment here was, that's what I will be watching for in a couple of years when they turn on the growth machine. Price should spike. Exactly. I will sell then and buy back when the price drops. Now, one thing that you reminded me, my dear friend, is that when the price of the stock ascends to its intrinsic value, which is what Scott, the CFO, is trying to do, they are most likely in 2023, 2024, once they get up to that, $8 to $10 to $11 region, or maybe 5 to 10, there's a high probability that they may dilute in future anticipation to turn on the growth machine. And we will keep track of this. We will keep track of this. All right, ladies and gentlemen, it's always a privilege and honor to serve the retail community. You guys mean so dear to our hearts, and we want to go ahead and continue educating you to build generational wealth and to essentially thrive in any stock market, whether it's a bull market or bear market. Remember, wealth is created not during bull markets. No, wealth is created during bear and recessionary markets, and finding stocks that no one wants and then selling them to when people want them. Again, you want to do opposite of what investors do. When everyone's basically running away from the hills, as an investor, you want to go towards the hills. That is when that's when the real money is. Essentially, it's a simple term. Be greedy when others are fearful. And that's what we need to be right now, which you see a lot of retail investors not doing. Many stock market channels have stopped talking about companies. What happened to them being greedy? Now it is the time to start being greedy. And once the recession hits in 2023, we must become even more greedy. Ladies and gentlemen, it's always a privilege. God bless each and every one of you, and I'll see you on the next one.